Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 950,000 reads and 57,000 likes. I've produced over 800 videos with more than 380,000 watch hours as of May 2025. I also focus on regional and global economic trends. Today, we're diving deep into City Developments Limited, or CDL, following their massive South Beach divestment that's got analysts talking. UOBK High-End just issued a hold rating with a target price of $4.60, representing a 12% downside from current levels. But here's what caught my attention. While the market celebrated this $834 million sale, the underlying debt story tells a different tale. Let me walk you through why this blue-chip property giant might be facing headwinds despite unlocking nearly $500 million in disposal gains. CDL just sold their 50.1% stake in South Beach to Malaysian partner IOI Properties for $834 million. This isn't just any property. We're talking about the Norman Foster designed complex in Singapore's CBD that houses JW Marriott Hotel, Grade A offices, and premium retail space. The sale values the entire complex at $2.75 billion, which is actually a 3% premium over its December valuation. Now, here's where it gets interesting. This divestment will generate $465 million in disposal gains for CDL. That's a massive windfall that should theoretically strengthen their balance sheet. The company expects this to improve their net gearing ratio from 117% down to 103%. For context, anything above 100% means a company owes more than they own in equity. So this is still concerning territory. But here's my first red flag. CDL explicitly mentioned they'll use these proceeds not just to pay down debt, but also to pursue new acquisitions. This is exactly what got them into trouble in the first place. Their total interest-bearing borrowings jumped from $11.6 billion in 2023 to $13.3 billion in 2024. That's a 15% increase in just 1 year. The debt burden is crushing their profitability. CDL's interest expenses surged to $588.7 million in 2024, up from $485.8 million the previous year. Think about this. They're paying nearly $600 million annually just in interest. That's more than many companies' entire revenue. What's particularly troubling is the timing. We're in an environment where interest rate cuts from the Federal Reserve are becoming less likely. The analyst specifically noted that expectations for significant rate cuts are fading, which means CDL will continue facing elevated borrowing costs throughout 2025. From a Singapore investor perspective, this creates several considerations. If you're thinking about CDL for your SRS portfolio, remember that REITs and property developers can be sensitive to interest rate cycles. Higher rates not only increase their borrowing costs, but also make their dividend yields less attractive compared to risk-free government bonds. For CPF investors, CDL's current dividend yield sits at around 2%, which barely beats the CPF ordinary account rate of 2.5%. Given the debt concerns, there's also dividend sustainability risk if cash flows remain pressured by interest payments. Let's talk about the broader property market context. Singapore's residential property prices rose just 0.8% in the first quarter of 2025, showing moderation from previous quarters. The government's cooling measures continue to impact transaction volumes, and with new household formation averaging 20,000 annually, demand growth is steady but not spectacular. CDL's strategy of capital recycling makes sense in theory. They're aiming to divest $1 billion in assets and have announced about $600 million so far, including the South Beach sale. But execution is key. The company needs to resist the temptation to immediately redeploy proceeds into new acquisitions that could rebuild their debt pile. Here's what I find encouraging, though. CDL's operational metrics remain solid. Their Singapore office portfolio maintains 97.4% occupancy, well above the market average of 89%. Their retail properties are at 98.5% occupancy versus the market's 93.5%. These are signs of quality assets in prime locations. The hotel division is also recovering nicely, with room occupancy at 73.8% and average room rates improving. This diversification across property sectors provides some stability during uncertain times. But let's address the elephant in the room: valuation. CDL trades at just 0.5 times book value and 0.3 times revalued net asset value. These are historically low levels, even below what we saw during the global financial crisis. The market is clearly pricing in significant risks. The Analysts' hold rating with a $4.60 target implies limited upside potential. Current trading around $5.25 suggests the market might be too optimistic about the South Beach proceeds impact. Want to access premium content before they are made available? For just $1 a month, you can become a premium member and unlock a wealth of additional content, including daily market analysis, early insights into promising trends, deeper dives into specific investment strategies, and perspectives that will give you a real edge in growing your wealth. Think of it as your daily dose of financial fuel. Just click on the membership tab to join. So what's my take on CDL? I'm cautiously optimistic, but with significant reservations. The company has quality assets and strong operational performance, but the debt burden is a major concern. Their success will depend on disciplined capital allocation, using divestment proceeds primarily for debt reduction rather than new acquisitions. For Singapore investors, CDL might appeal to those seeking exposure to prime CBD assets at historically low valuations. However, the high debt levels and interest rate environment create meaningful risks. If you're considering CDL, treat it as a recovery play rather than a dividend income stock. The key catalyst I'm watching for is their ability to execute the remaining $400 million in planned divestments while maintaining operational performance. If they can reduce net gearing below 100% and demonstrate disciplined capital allocation, the stock could see meaningful re-rating. My recommendation aligns with the Analysts' hold rating. CDL isn't a clear buy at current levels given the debt concerns, but the valuation discount might limit significant downside. For those already holding, monitor their quarterly updates closely for signs of deleveraging progress. For new investors, consider waiting for either lower prices or clearer evidence of debt reduction before taking a position. The Singapore property sector faces headwinds from cooling measures and interest rate pressures, but quality assets in prime locations should maintain their value over time. CDL's challenge is proving they can unlock that value while managing their debt burden responsibly.